Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Check 1, 2. Yep, there we go. Sorry, I was muted. So, good morning. Welcome to the Hump Day edition of the Real Investment Show, post-freeze in Houston. Yes, so, Texans always brag about being, tough, rugged. Yeah, all New England's laughing at us. I mean, but, I will have to say this, right? If there's a hurricane, 3 feet of water, that's okay. We're out back somewhere drinking some margaritas, but an inch of snow, we're done. So yesterday, everybody frozen in. Nobody got anywhere yesterday, so apologize for no show yesterday. Back today, though. Still very cold here today. But if you don't like the weather in Texas, hang around a minute because on Sunday it'll be 70 degrees. Yes. So this will be over, and we'll be back to our normal sweltering weather. As usual. I was telling my wife was complaining over Christmas. She's like, it's just not Christmas with it not at least being a little bit cool. I said, just hold on to your beanie there for a minute because we haven't got to January yet. So now she's going, and I have a good story for you this morning with my wife and the dogs. So we'll get to that in the first segment. But she's done with the cold weather. She's ready for it to warm up a bit. So anyway. All right, let's talk about a few things. A lot of stuff happening over the last few days since markets were closed on Monday and we weren't able to be with you on Tuesday yesterday. Of course, inauguration of the president. He's in. Executive orders flying out the front door right now. This morning, the Trump administration announcing a $500 billion investment into AI. Sam Altman with OpenAI, Larry Ellison with Oracle, others all coming together to commit to spending up to $500 billion on increasing AI infrastructure, AI itself in the country. Again, one of Trump's kind of platforms was to be a leader in AI, and this will certainly help boost those stocks that are participating in that sector. Another side of that, of course, also becomes the infrastructure for energy as well. Trump signing a recent executive order to drill, baby, drill, basically. But we're going to need energy. Most of that being natural gas, at least at first. Nuclear is going to be great, but that's 10 years down the road. Unless they can expedite the permitting process and all that. It takes about a decade typically to build a nuclear power plant. There's a lot goes into it, obviously, but a lot of that has always been due to regulations, permitting, et cetera. So if the government can streamline a lot of those regulations and permitting, maybe we can speed up that process some. But in the near term, it's going to be natural gas and natural gas pipelines that are delivering a lot of that energy for AI. So that should help benefit utility stocks, particularly those that are providing the energy, companies like American Enterprise Partners, Duke Energy, et cetera. Then also the pipelines like ONEOK, KMI, and others that are delivering the natural gas for that energy production. So that announcement is going to have some ramifications to the economy, should help create some jobs, of course. Now, this is one of the things that we talked about. These type of infrastructure programs, economic growth would slow back to its normal trend. It may still, right? But if we start injecting hundreds of billions of dollars into the economy near term, that should help sustain economic growth here, at least for a while, certainly deter any potential onset of a recession. That would also certainly help benefit earnings, et cetera, for companies, obviously, because money getting spent in the economy is a good thing. So we'll see how this all plays out. Again, these are just announcements. Nothing has shown up in reality. Of course, we've seen these type of announcements before that did not come to fruition. We saw that during the Obama administration. The $800 billion infrastructure package that was announced turned out later that getting shovel-ready jobs weren't actually quite so shovel-ready, and they never really got into the economy that much. So again, announcements are one thing, actions are another. We'll see what happens here. But again, all good stuff here. That's certainly helping support the markets this morning. Markets are certainly ticking up again. We'll get to that in just a moment. Outside of that, though, there's going to be some negatives that come from some of these announcements. Deportations, et cetera, are going to impact labor markets. So again, that's something that we'll have to watch. Again, we've talked about this before. We addressed this past weekend at our Economic and Investment Summit. We had a lot of questions around policies. And one of the things that we did discuss is it depends on how rapidly these policies are implemented. A good example was everybody was worried about tariffs and, it's a 100% tariff on China. This is going to be a big impact to the economy, going to cause a lot of inflation. Well, it turned out to be a 10% tariff. So again, big differences between what we thought was going to happen and what's going to actually happen. And again, those tariffs may go up, but they're not coming all at once. Same thing with deportations. Yes, if we could massively overnight have alien spaceships come down, just absorb up all the illegal aliens, they go away tomorrow, that's going to impact the economy. The speed of implementation is going to be the most important thing. If deportations are spread out over a long period of time, it allows time for businesses to adapt, hire other people, replace those jobs, etc. So again, these are the things we have to watch closely to see what the actual impacts of these policies turn out to be. But the speed of implementation is also going to be very, very important to watch. Okay, here's what you need to know before the bell this morning. Markets are doing very well over the last couple of days. Not surprising. We had talked about here on the show previously that periods of very bad breadth. We had a lot of stocks trading below the 50 and 200-day moving average. When you have a lot of that weakness in the market, that typically tends to mark the bottom of a correctional phase. And so we had this correctional phase that started in early December. Stocks came down to the 100-day moving average. We've now bounced off that support. And importantly, money flows, we saw this start to turn up towards the end of kind of really December, early January. Market started to try to bottom here a bit. We got kind of deep oversold conditions on a relative strength basis. And we saw those money flows turn positive. And so as those money flows have turned positive, that certainly helped now pick up asset price returns this morning. Futures are pointing higher. S&P is indicated to be up about 30 points this morning. The Dow up 132. Bit of follow through on the rallies, not surprising here at all. We're back on a MACD buy signal. Again, we kind of needed that support from the markets. We had a good long period of sell-off in the market, hedge fund de-risking. We brought sentiment down a good bit. The number of retail investors, liking stocks had fallen a good bit. Now they're going to have to start kind of chasing the market to play catch up. This morning, Netflix announced boomer earnings this morning, 19 million plus subscribers. That stock's going to be up 14% at the open this morning. That's going to help lift the whole kind of technology sector itself, and so we should start to see technology communications kind of follow through on this rally. Bank stocks have been performing okay as well. We've seen money flows into financials. Markets are starting to push back up here into overbought conditions. So as we start to approach all-time highs here, this is going to be our next big level of resistance. If you've been looking for an opportunity to kind of rebalance your portfolio a bit, this is a good time to do it. So, can we break out to new all-time highs? Absolutely. We've got plenty of room to go on this MACD buy signal. Again, breadth has got room to go here, but again, just a bit of caution here. If there's positions in your portfolio that you've been wanting to change, you didn't like this sell-off, your portfolio didn't perform well, you have too much risk, use this opportunity. Doesn't mean do it all at once today, but just start taking little small bites and just changing that allocation structure, getting positions in your portfolio you like, remove ones that haven't been performing. Do kind of follow those gardening rules that we laid out in our report on this past Friday. So again, that's on the website, realinvestmentadvice.com. It's the rules of gardening into your portfolio. That'll help you, kind of give you some kind of things to think about in managing your portfolio. But everything's fine here. And we'll kind of see what happens today and follow it through for this week. But that's what you need to know before the bell this morning. We'll be back. Lots of stuff to get into. Talk about the economy and markets as well. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, funny story this morning. So I get up and alarm goes off at about 3:30 this morning, and I start kind of rolling out of bed and get in the shower. And my wife got up with me this morning because just recently our older dogs. We have two dogs, as you know. I've told you about this before. We have Gunner and Sniper. So Gunner is the older dog. He's a black and white, spotted like a dairy cow, half German Shorthair Pointer, half Terrier. And he's older. He's about 11, 12 years old now. And I'd taken him to the park for a walk, and he went, and they love to chase squirrels. That's when we go to the park, they chase squirrels. That's their thing. And they never catch anything. They're the worst hunters ever, but they never catch them. But it's like squirrels 9,000, dog 0. But it took him to his park, and he started running after a squirrel, and all of a sudden he kind of yelped and started limping, and so I had to carry him back home and took him to the doctor, got him x-ray. He had torn his ACL. So we had to drive him to Austin 2 Fridays ago to have ACL surgery, and there's a whole nother story to that. It's $4,500 I'm not going to get back. Yeah. I swore I would never do that to a dog. Dog gets injured, just gonna put him down. No, that's all talk. Let me just tell you. As soon as I had to carry him home, I was like, it's okay, we'll fix you.
You might as well have another kid.
I know, right? And there's a whole nother story about that. My dogs would be such an embarrassment. Like if their ancestors ever came back, they'd say, okay, it's time to eat. Let's go hunt something and kill something. And they're like, no, you just gotta wait till 4. It just shows up. Let's go huddle up out and under the tree, right? Yeah. No. You just stay here. We get blankets. We have our own beds.
And if it doesn't show up, they jingle the
food bowl
pan with their nose.
Yeah, exactly.
It's time.
Exactly. So it just my dogs are embarrassing. But anyway, so he's been recovering, and he has to. So we have to let him out and just have to be careful with him because he can't run yet. He's not supposed to run because they don't want to re-injure the injury. Well, it's cold outside this morning, and so my wife lets them out on the side of the house, and so they can kind of go do their business real quick. And normally they're really good. They just go out, do their stuff, they come right back, and they get their breakfast. Well, this morning, the younger one goes out. His name is Sniper, and he saw a rabbit. And he takes off after this rabbit full steam. Now, mind you, this is about 4:05 in the morning. So the older dog just sees the younger dog takes off. So he's like, okay, well, I'm going to chase him because he's obviously chasing something. So he takes off, and now they're headed towards the park, chasing this rabbit. My wife is now in furry slippers and her PJs in 25-degree weather outside, walking fast after the dogs, right? Silently whispering at them to come back because she can't yell. It's 4 o'clock. She'll wake up all the neighbors, right? Come back. Yeah, exactly. So the brown one, the sniper, he's really well behaved. So as soon as you tell him to come back, he comes right back and he does his thing, right? Heel, comes right back. The older one, he's just ignorant. So he decides that, well, he's already at the park. It's time to go for a walk because we take the dogs for a walk every weekend. Well, until he got injured. So he hasn't been on a walk in a couple of weeks. And so he goes, well, it's time to go for a walk. So here's my wife now chasing the dog at 4 o'clock in the morning to get them back home. So finally she tells the dog, she says, Gunner, let's go for a ride. That's his favorite thing, right? He's like, oh, okay. I told you he's stupid. Comes right back, right? So I said, why did you do that to start with? But anyway, so I'm in the shower. All I know is that there's now 2 dogs hiding out on the other side of the shower this morning because my wife's threatened to beat them. She is so mad. I was like, honey, what is going on? She tells me this whole story and she is just fuming mad because she's now cold. She's upset because she had to chase the dogs. So I'm now here at the studio because I'm afraid to be at my house. I was like, ice outside? Don't worry about it. We're driving to the studio this morning. Anyway, antics for the dogs. All right, a few things to get into this morning. Yes, Sharp's Law, the Ring video will be made available sometime soon here. I just have to download it. Anyway, a few things this morning. So I was doing a Fox Business interview yesterday with Charles Payne, and we were talking about, he's very bullish, right, on the markets right now. It's very optimistic. Obviously, new administration. CEO confidence has had a huge jump. I told you about the NFIB and that the National Federation of Independent Business, they do a survey, and right after the election, the survey of small businesses skyrocketed to basically an all-time record. It's right up there at some of the highest levels ever, going back to like 1986. Very optimistic. CEO confidence has also likewise had a very significant jump. CEOs are very confident about the new administration, deregulation, those type of things. So they're becoming more confident about, spending outlooks, those type of things, hiring, etc. Now, you have to be careful with these because these are surveys. And it's the one thing I tried to explain to him yesterday is like, these increases in sentiment are very good short term. And yes, they are going to help support the market short term because, again, everybody's very optimistic. I've gotten just tons of emails. I deal with a lot of business owners. I have a lot of connections in the business community. And, I'm getting a lot of questions from them going, hey, this is really good stuff. What do you think? Is this going to, if I start spending money here, you think that's going to be okay, right? So there's a lot of optimism about expanding businesses, do those, and taking advantage of opportunities. Lots of optimism around tax cuts being made permanent now. And so that helps this, the outlook on spending. That's good short term, and that leads to a lot of sentiment. And we're seeing that reflected here in the markets over the last few days as well, as markets are kind of rallying back. As I was saying earlier, there's a difference between sentiment and reality. And business owners respond to actual changes in demand more than they respond to sentiment. They're very optimistic, right? And a good example of this is in the NFIB index. If you take a look at the NFIB index, they said, okay, what do you think about, the business environment? I think it's great. Good time to expand. Okay, well, you're going to hire a bunch more people. Yeah, maybe. Right? There wasn't a big jump in hiring expectations. Huge jump in sentiment, not a big jump in expectations. Big jump in expectations for retail sales, but not an actual increase in retail sales. So what's important about this is that if we're going to see follow through on the sentiment, we need to see the actual actions come to fruition, but that is going to depend on actual demand from the economy. So it's not really the sentiment we need to be paying as much attention to as the actual actions of consumers, which is where the demand comes from. And this is going to be one of the challenges that we kind of look for this year as we move forward, particularly with markets that are already very exuberant, very overvalued on multiple levels. If you take a look at market cap to GDP, that's at some of the highest levels on record. Valuations are like second highest level on record. So when you take a look at what's priced into the markets, and this is kind of the crux of my conversation with Charles yesterday, is that most of the good news is already priced into the markets. The markets are priced for perfection. And so while the election of President Trump is very positive, this is going to have a lot to live up to because markets have already priced this in to most levels. So we'll see what happens. But this is, kind of the crux of the article that I wrote yesterday. It's on the website now. That and again, some of these charts that are in that article were charts from this past weekend's conference. If you weren't able to make it to this weekend's economic and investment conference, we missed you. It was a lot of fun. Got a lot of chance to talk to a lot of people, and we'll certainly do it again next year. I've already got some good ideas about things we'll change for next year, things we'll add. But again, I've got a couple of those charts from that presentation are in the article from yesterday. Now, the full set of slide charts are going to be mailed out to all the participants. So those of you that are listening right now that came to the conference, thank you for coming. It was a lot of fun. Nice to meet you. We're just putting together the links now for the presentations. We'll get those emailed out to you, to all the attendees here shortly. But here's the first chart. This is consumer confidence, and this is what I'm talking about. Consumer confidence in stocks, we've showed you this chart before, is at the highest level on record. And that is a reflection of valuations, right? So as people become more confident in stock prices, they're willing to overpay for earnings, the earnings that companies generate. That brings your valuations up. So that's why there's a very high correlation between consumer confidence and higher stock prices and where the markets are. The problem is that there's nowhere to go from here. So this is one of the challenges that becomes a problem as we look forward to later on this year. Again, everything is really just about as good as it can get. Economically, firing on all cylinders, inflation's coming down. We're having kind of the renaissance period in a lot of these asset prices. Question is, where do you go to from here? That's going to be the challenge as we look forward, because now the bar is set so high for companies to meet. And we'll talk about some more of this after we come back from the break. That's the risk that we look for as we move forward into 2025. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So how many Gen Zers to take change the light bulb? 5. According to a new study conducted by the motoring and cycling retailer Halfords, 1 out of 5 could not change a light bulb.
The Real Investment Show podcast.
1 in 5 feared that the light bulb was too hot to touch.
Same show, your schedule.
And just when you thought it couldn't get worse, 20% said that going up a 5-step ladder was simply too dangerous.
At realinvestmentadvice.com.
We have failed as parents.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Interesting comment in a chat this morning, kind of goes along with our conversation. Says, if everything's so good, why is gold back near all-time highs? Because in a market where there's lots of excitement, everything goes up. Gold goes up, stocks go up, Bitcoin goes up. It's basically just too much money chasing too few assets. So anything that's moving higher gets the money flows. And so we're just in that kind of environment right now. It's risk on all across the board. And that's okay. Nothing absolutely wrong with that at all. Again, our job's to make money, and so it doesn't really mean anything in the near term as to what's going on. And again, this is one of the significant problems as we look forward, out this year. This was a chart I had at the conference. So this is various time periods over the markets. Now, calculating returns in your portfolio is very easy to do. All you have to do is you take your expected rate of GDP growth plus your dividend. That's your nominal return. Then you subtract out inflation. So if you think economic growth is going to be 4%, 6%, 2%, whatever that is, add in your dividend, that should get you very close to your nominal return. And we can prove that. If we go back to 1948, now these are total returns coming out of the markets going back to 1948. So from 1948 to 2024, the economy grew at about 6%. The average dividend yield was about 3%. So you had about a 9% return. So there it is, right? Nominal GDP growth plus dividends gets you your return. Same thing if let's just strip that out. Let's just look at 1948 to 1999. Same thing. You had about a 7% rate of return coming out of the economy. You had about a 10% rate of return coming out of the markets. So no matter how you break it out, normally going back historically, you've done very well. Except the real interesting part is that from 2009 to present, the markets have been generating about a 12% average rate of return, but the economy's been growing at about 5%. So 5% plus 2% dividend yield does not get you a 12% rate of return. So the markets are outgrowing the economy over the last really 15 years. And they're outgrowing earnings. So earnings have been growing at about 7%. So, the market is outgrowing even earnings growth. It's outgrowing revenue growth by leaps and bounds. It's outgrowing economic growth. And again, where do earnings come from? Earnings come from economic activity, is what you and I buy. So in order to generate revenue for the company, which is what happens at the top line of the income statement, I go out and buy stuff. That generates a sell for a business. That's top line revenue. Then I subtract out my expenses and I get down to my earnings, what did I actually earn. That the market has been outgrowing that. So we are paying more and more for every dollar's worth of earnings on the expectation that this can just kind of keep going indefinitely. And it's gone for a very long time. And of course, this has all been driven by trillions of dollars worth of money being injected into the system, HAMP, HARP, TARP, QE, zero interest rates, etc. Again, too much money chasing too few assets. Private equity's been booming, right? We went through the whole period of SPACs and IPOs and all that stuff because, again, just everything, it's just one of the kind of the idiotic statements of investing is number goes up, so I buy it. It's interesting, just over the weekend, Trump launched a meme coin, and it added like $30 billion worth of value in like 24 hours. Now, there's nothing behind it, right? It's just simply a speculative asset. Again, too much money chasing too few assets. Every number goes up, right? Now that's fine. Again, you just have to understand that's the market we're in, and we're in that market right now. But markets have been outgrowing fundamentals for so long. This is why valuations are high on multiple fronts: market cap to GDP, valuations, you name it. We've got very, very elevated valuations. Stocks are trading at astronomical valuations. Companies like, I've never seen in the last 30 years so many companies all trading at price to sales ratios of 9, 10, 11, 12, 20. That never existed previously. Back in 1999, it was amazing to see stocks trade like Sun Micro trade at 10 times price to sales. That was astronomical back then. Stocks should trade around 1 to 2 times price to sales historically. And now we've got stocks trading at 20 and 30 times price to sales. But this is that environment, that speculative environment that we have generated over the last 15 years because, again, of all this money. And look, here's the long term. This is a 3-panel chart of S&P returns, year-over-year EPS growth, and GDP year-over-year growth on a nominal basis. Again, just kind of laying out this whole premise that the markets are outgrowing the economy, which is what's happening. The average kind of growth rate for the S&P earnings is about 7.7% annually. The growth rate for the actual market's been about 9%. That's where you get that 10% return from. That includes dividends. And you take a look at GDP growth growing at about 6%. So they're all very correlated historically, except over the last decade. And it's kind of starting to skew these numbers. We're now starting to skew valuation levels higher, right? Average valuation levels are skewing higher now because of all this kind of monetary intervention and things like stock buybacks, all these things that have been driving markets over the last, kind of 15 years. And that's an anomaly. And now, does that change in the future? But the point, I don't know. But the point is, if we're going to maintain this type of exuberance in the markets and these types of transactional issues that have been going on, we're going to do $1 trillion worth of buybacks this year. another one of the reasons that the market has been rising here over the last week in particular is that the window for buybacks have opened back up. And we went from a negative flow, a negative 4-week change of buybacks, to a positive 4-week change in buybacks over the last 2 weeks. So again, that reintroduction of buybacks into the market, of buybacks into the market is helping boost stock prices. And that's going to continue now for the next 3, 4, 5 weeks as we go through earnings period and that window opens back up. But again, this is, as we look forward into 2025 and you look at the deviations of markets from their long-term means, the deviation of values from the long-term growth trends, right? We're at some of the highest levels that we've seen historically. So again, I'm not saying the markets are going to crash. Don't make that assumption, because that's not what I'm saying. But I am suggesting that, as we kind of look forward here, that we need to temper our expectations a bit, because there is a higher risk of disappointment of earnings growth, expectations, those type of things than we've seen in quite a while. And those typically lead to at least slower rates of return, if not correctional periods. And we've kind of been laying this case out since the beginning of the year. And there's not really any evidence that anything has changed, except for the fact that we now have a new president who is in office saying the right things to help support kind of the bullish views, at least near term. But again, my point is that while it's very bullish, the things that he's saying and doing for the markets, deregulations, those type of things, that's great. Actual translation into consumer purchasing is going to be the other side of it. Business investment, $500 billion in investment and business investment is a good example. That's great. That takes time to come into the markets, a couple of years, 2-3 years, whatever it is, to build out AI and all this. It's not going to happen. No, it's not like tomorrow $500 billion is just going to get dropped into a checking account, right? But that's a very small percentage of the overall economy. The big driver comes from consumption. So business investment, if you take a look at GDP, right, as a function, how do we calculate GDP? GDP is about 70%, 68%. Personal consumption expenditures, about 12% of that. On top of that, so you have personal consumption expenditures, then you have government spending, business investment, and net exports. Business investment accounts for about 10 to 12% of GDP historically. So $500 billion is great, but it's a drop in the bucket compared to a $28 trillion real economy. So the consumer is going to have to continue spending and operating, and what do they need? They need lower prices, they need higher wages, they need more savings. And right now, savings are declining, wages are declining, and prices are still elevated. So they've got a lot of headwinds that they're dealing with that may curtail some of that economic growth that retailers and business owners and CEOs are counting on. That may not come to fruition as soon as kind of markets are expecting. That's the potential disappointment to earnings as we get further into the year. All right, come back, get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm just reading this article in the break called Boomer Asking. Yeah. People, you have got to develop a thicker skin. The Wall Street Journal went through this whole article today talking about, does this scenario sound familiar? A colleague approaches and asks, hey, what are you up to this weekend? You tell her you're not sure, but nothing big. And then he or she, explains that, hey, they're going to their lake house this weekend and blah, blah, blah. Now you feel bad because you don't have any plans and they do. Get over it. I don't know what happened, but people, you've got to develop a thicker skin, than, having your feelings hurt constantly. It's getting a little bit ridiculous. Anyway, yeah, this is true. The source does come from the Wall Street Journal. What'd you do this weekend?
But enough about me. What do you think about me?
Exactly. Oh, goodness. Anyway, all right. So anyway, just kind of wrapping up about the markets. Just again, kind of the point of the market, the conversation we're having this morning is just curb your expectations. Again, we wrote an article about this just recently, called "Curb Your Expectations," and I think that's just going to be a good mantra as we move into this year. The markets are still probably going to have a good year this year. And expectations are very high that markets are going to generate another 15 or 20% return this year. Everybody's very optimistic. And, when you have everybody kind of on the same side of the boat, that's just a good time to kind of just, think about risk in your portfolio, kind of, put some risk management protocols into position. And it doesn't mean you have to do anything today, right? But look at the assets you have in your portfolio. And look, there's some good things good ways to kind of approach your portfolio management. One of the things to do is look, there's no bad asset. Everybody's got an opinion about an asset, right? I like gold, I like Bitcoin, I like stocks, I like bonds, whatever it is. There's no bad asset. They're all fine. They all have different purposes. They all provide different benefits. They all provide different environments. But our goal is to grow our money, right? So whatever thesis you have, take that thesis and throw it in the trash because it doesn't matter. Look at the assets in your portfolio and say, okay, what is performing, what is not performing, what is providing a hedge, what is not providing a hedge to my risk, and how do I balance those accordingly? And once you kind of start stripping out all the theses that people throw out there, it makes your life a lot easier in terms of just managing your portfolio, because now you just have to look at performance and just say what's working, what's not working, what is doing what it's supposed to do, what's not doing what it's supposed to do. And I've showed you this before. We have this on our SimpleVisor website, and this is performance analysis. And I'm just going to give you a good example of kind of what we're talking about. So what this chart shows you is performance of assets over the last 5 days, the next 20 days. And you can do this yourself. You can change it. You say, look, I want to look at, I want my first column to be the last 20 days. What's been performing over the last 20 days? What hasn't been? And I can look at the next 20 days, the next 20 days. You can change those parameters to whatever you want, but you can build it out so that you can look at rolling rates of performance over time. And so when we kind of look at the markets right now, for instance, mega cap growth over the last 20 days have been underperforming a bit. We know that, right? Because technology has been underperforming. And momentum stocks and gold miners have been doing very well. Well, they had gotten really, so over the previous 20 days, though, this is the importance of the analysis. Over the previous 20 days, mega cap was the big performer, and gold miners were getting hammered. So looking at my portfolio, I'll go, okay, great. I've got these volatility periods in my portfolio, and I know that sometimes some assets are going to outperform, other times assets are going to underperform. And so by looking at balancing what tends to outperform over time versus what doesn't outperform over time, and particularly what's been underperforming over certain periods as of late, will kind of help keep you on the right side of your portfolio. And this is kind of the key factor. And if we can kind of look at factors themselves. So, this is one of the, kind of the structural issues of your portfolio is looking at the factors that you have in your portfolio, value versus growth, those type of things. And so if we take a look at relative performance of the market, so this is relative performance of different factors relative to the S&P 500. So are these factors outperforming or underperforming relative to the index? Because what's our goal, right? Our goal is to grow our money for retirement. That's our sole goal. We don't really have any of that's our whole job with managing our portfolio. So if we're going to manage our portfolio, we want to know what's outperforming and what's underperforming, and then adjust those exposures accordingly. So if we take a look at what's been outperforming as of late, value's been grossly underperforming. So if I've got a portfolio that's built with a lot of emerging markets, as an example, low beta stocks, value stocks, those sound great, right? But I've been vastly underperforming the S&P 500. On the other side of that coin, though, momentum, ARC-type disruptor companies, a lot of speculative assets, S&P 500 growth, small cap growth, those have been outperforming. Now, a lot of those are really pushed up into the outperformance category, so we're probably going to get a rotation here sooner than later, and stocks like momentum, we'll see those come back down the other direction. So this is where we start looking at the portfolio going, okay, I've got a lot of momentum stocks in my portfolio. I need to reduce some risk because momentum is going to rotate. Doesn't mean today, doesn't mean tomorrow. Doesn't even mean next week. But we're going to see a rotation in momentum over the course of time. And again, if we just take a look at, so this is momentum where it was, but if we take a look over, say, the last to 8 weeks. So you can see that momentum kind of rotates all over board. We just talked about how mega cap was underperforming over the last 20 days, but had been outperforming the 20 days before that. Well, that shows up here, right? Right now, we've got momentum all the way back in the top. So this is probably a good time to say, hey, let's go take some profits in my momentum. Doesn't mean sell them all. It just means reduce them back to target weights. And let's go take a look at potentially, let's say, value, which has been underperforming as of late. So maybe I add to some value stocks in our portfolio, and maybe we reduce our momentum stocks a bit. Just kind of do a rebalance. And again, this goes with everything. This goes with, we can take a look at, for instance, momentum versus gold miners as an example. Oh, sorry, let me fix that. This is actually momentum versus gold miners. So gold miners have been improving, had gotten really oversold. Not surprising, gold had sold off, but gold miners have been starting to improve. Momentum's improving. So these are all kind of moving back up into overbought areas of the market. So again, kind of think about rebalancing that risk in your portfolio. So see, the point is it doesn't matter what your thesis is. I think small cap, mid caps are going to outperform this year. I want to be a small cap, mid cap guy. That's great. I want to own gold and gold miners. Great. I want to own Bitcoin. Great. No, it's no problem. All these assets are going to go up and down in price. So when they get really overbought and extended, if they are outperforming markets on a relative basis for a long period of time, they are going to correct. So this is why you want to have some assets in your portfolio that can act as a hedge, but you want to minimize those to a point that they're not the entirety of the portfolio. It's okay to hedge your portfolio, which is going to lead to some performance drag, right? If the S&P is up 10, you're going to be up 8, right? But when the market's down 10, you're going to be down 2 or 3 because of those hedges you have in your portfolio. That's okay. But you don't want to have your whole portfolio built into something that is grossly underperforming the market on some thesis that the world's going to end or we're going to have this massive, bear market right around the corner. Because again, people were calling for a bear market over the last 2 years, and they missed out on a 50% return in the market. So just focus on what the markets are doing. We provide a lot of tools on SimpleVisor to help you do that. You just have to take the time to do the analysis yourself. And by looking at these risk adjustments in your portfolio, you can perform better over time. You can create relative performance for yourself. And you can create absolute performance for yourself, which is really what we want to focus on. What's more important, relative or absolute? Absolute performance trumps relative performance all day long. Because our goal is to create a set rate of return every year. We want to create, 5 or 6 or 7%, whatever your number is. You just pick your own number and be realistic. But pick your number and then build your portfolio to generate that number. And as long as you're generating those absolute rates of return that you need, you're going to be fine long term. Where we go wrong and what leads to big capital destruction is not paying attention to the risk that we're taking, or just as bad, we are invested in all the wrong areas of the market. Both of those lead to poor performance over time. Anyway, if you haven't checked out SimpleVisor, it's first 30 days are free, but all those tools are there for you, and we've got a lot more that we're adding. Just added our risk range report on a daily basis. That's there as well now. Anyway, have a great day. Be back here tomorrow with Michael Leibowitz. We'll catch up on everything Fed, interest rate, bond related, kind of talk a little bit about what we said at the conference this weekend. And we'll see you back here tomorrow on the next Real Investment Show.